But yeah, my name is Christian Citarella. I'm the Chief Property and Casualty Actuary at the New Hampshire Insurance Department. I've been there just over 10 years. And among my roles, my main role is to review P&C insurance rates and rules. Every insurance carrier has to, by law, submit all of their rates and rules for review, and then they need to be filed with the department, and then they need to follow their own rates and rules. Other things that I do at the department is I more or less oversee anything that involves workers' compensation. Most of the workers' compensation laws are administered by the Labor Department. Anything that has to do with anything dealing with claims on the workers' comp side, anything to do with employment questions and who needs to be covered and who isn't, that's all a labor issue. But as far as issuing of the policies, rates, and that sort of thing, that's on our side, on our responsibility, so that kind of the before the policy. Also dealing with audit, any questions having to do with premium audits after the fact. So workers' comp is something else that I think about from time to time. And then my other responsibility is to make sure there's a law for RSA 412, 13, and 14 that deals with monitoring insurance markets for the level of competition within the markets to make sure there's a healthy competition within the markets. And so that's another thing I do. I review the kind of the health and well-being of different insurance markets. And then we get pulled in from time to time in other issues having to deal with legislative issues and things like that. But today we're going to talk about P&C insurance rate review. So what happens when an insurance company submits a rate request or a change in their rates to develop premium. And I'm going to be focusing mostly on personal lines, and the examples that I have are with homeowners insurance. But any of these concepts, any of these issues can all be, they all apply to every other line of P&C insurance. There are some lines, there's about a half a dozen or so, that are exempt from filing rates and rules. Things like directors and officers, things like employment practices liability, sort of these niche coverages that the understanding is that there's too sophisticated, sides to the contract, and they're going to be able to work it out on their own. Everything else in the commercial side or in the personal side needs to be submitted rates and rules. So when I talk about these issues and these concepts, as an actuary, I always start by reviewing the CAS principles of rate making. And there are these four basic principles are what actuaries think about when they're developing proper premium, when they're developing the rates for the writing of insurance. And again, this is property and casualty. A rate is an estimate of expected values of future costs. A rate provides for all costs associated with the transfer of risks. That's important there where we talk about all costs. This is not just dealing with the costs to cover claims. There are other things involved. A rate provides for the costs associated with an individual risk transfer. This is the concept of having rating factors and classes, risk characteristics, and individualizing the cost of insurance for a particular risk or exposure. And then the fourth principle kind of pulls the others in together. A rate is reasonable and not excessive, inadequate, or unfairly discriminatory if it is an actuarially sound estimate of the expected value of all future costs associated with an individual risk transfer. So what I'm going to do now is kind of go through each of those first three principles and kind of describe it a little more, and kind of the way I explain the basics of insurance pricing to folks. Now, most of this I understand this is what you deal with every day. And things will get a little more deep as we go, but just let's go through some of the basics. At any point, if there are questions, if there's a term in there that you're not familiar with or something that you want to learn more about, you're welcome to ask it, or there will be time at the end, again, to ask questions. So I wanted to take just those first three principles and kind of expand on them a little bit more. The first principle, a rate is an estimate of the expected value of future costs. As you're well aware, insurance contract differs from every other type of purchase of most other products in that the seller, the insurance company, really doesn't know how much it's going to cost until after the contract is sold, right? And I give the example of, when explaining this about it's different from selling a television. If I don't know who RCA or whoever builds the television, Mitsubishi builds the television, LG, they know how much it costs to build a television. They're going to sell you the television. They can decide the profit, and the retailer can put up their piece of it and whatnot, but they know the sunk cost. Insurance company does not know that until after the contract is over. And so there's a lot of work that needs to be done to properly anticipate and to understand how much it's going to cost. And so actuaries do an awful lot of work in projecting loss costs going into the next contract. And this is a prospective activity. Second issue, the second principle deals with all the costs. So rate provides for all costs associated with the transfer of risks. Homeowners, and again, this, you probably know that there's a lot more that goes into premium than just the ability to pay claims, right? This is an example from one carrier that submitted a rate filing. This is a few years old now. Some of these numbers I'm seeing differ on the homeowner side these days than they did 2 to 3 years ago, but they're not too much. They're not too different. The average, a relative, representative sample of a homeowner's premium, you might see a little under 50% will be expected to pay claims. Claims adjusting, the bottom right in the orange, is going to cost, in this case, about 3%. Usually I see it a little bit more than that, although in other lines of business it tends to be higher. Homeowners tends to be a little bit lower. Commissions, of course, is part of this. It tends to be a little bit greater in the personal lines, less so in the commercial lines. What's that? Taxes, licenses, and fees is always about 1.8%, 1.6%. That's the business. That's the premium tax in the state of New Hampshire, and then there's other fees for in order to file your forms and to get licenses and that sort of thing. But it's always right around 1 to 2%. Other acquisition and general expenses, about 13%. Profit and contingency, 10%. We are seeing that number come down a little bit over the last couple of years on the personal line side. But as I try to explain to folks, carriers are businesses and they do need to make some money. One thing that the personal lines side needs to do is kind of make more of that money up front, because these are not long tail lines. For commercial lines, for liability coverages, for workers' comp, you're not going to see that kind of profit and contingency component. You're going to see that down in the low single digits, and sometimes even zero, because they're going to be making their money on investing of reserves. Reinsurance is definitely a piece of the puzzle here. This number, that's at 8%. I've seen that actually a little bit higher of late, just because of the cost of reinsurance for homeowners policies, homeowners insurers is going up. And so this is how a homeowner's premium is broken down, because a rate has to account for all costs associated with the transfer of risk. Rate provides for the costs associated with an individual risk transfer. Individual risk transfer means that it needs to match the risk that you're selling. This is where you're trying to explain to your customers, right, your consumers, that if you double the size of your home, right, it's gonna cost more money if you have a larger coverage A amount. In building materials, you might be able to save something, right? If you move from building your home out of wood and building it instead out of bricks or whatnot, it's going to be less expensive. Age of the home, age condition of the roof, these sorts of things. We can talk a little bit more about prior pay claims, insurance score, the deductibles, these sorts of things. This is how we make the premium, the price of insurance, fair reasonable for the individual risk transfer. So when we're looking at insurance and P&C rate filings, when they come in, it's important that carriers review the law beforehand. Oftentimes I joke about how I became an actuary and I dealt a lot with numbers and formulas and mathematics and whatnot. And then I come to the department and I feel like all I do is read law all the time. But that's the role that I'm in. I'm an insurance regulator, and our task at the insurance department is to enforce the law as a designee of the commissioner. And so the laws that the law, the RSA 412, 15, and 16, those two laws are basically, I tell people that's where I live. Those are what govern what I do. I also listed a couple, in a minute, we're going to kind of walk through RSA 412, 15, and 16 in more detail. But I just wanted to remind you of a couple of the regulations that are also there, the administrative rules that we look at on the P&C side. And that's insurance. INS 5000 deals with the process of filing forms and rates. INS 1400, that's the private passenger. Forgive me, I'm going to highlight, Emily is our lawyer on the P&C side, and she's an expert in, she's an expert in all of these, but particularly 1400. There's some quirky things in there that are New Hampshire specific. That's where we get on the auto side. The take all comers law is there, where anyone who, any resident of the state of New Hampshire can purchase an auto policy, essentially. INS is at 2800. That one doesn't come up all that often, but that comes up on the commercial end when you are using loss costs and you have to fill out a reference filing adoption form. INS 3300, that's insurance scores, that's credit. That's the use of credit in insurance. INS 4700 is travel insurance, which is a little bit of a bane of my existence. Not a big fan of travel insurance because it's very quirky. In many ways, it kind of sits between the two sides of the building because there's an accidental health and accidental health component to that, and so we need to collaborate on both sides there. All right, so I wanted to just take a read through real quick of the highlights of RSA 412, 15, and 16. Again, this is where I joke. This is where I live because this is what governs my abilities to regulate and puts limits on what I can have insurance carriers do when they're proposing new rates. Rates shall not be excessive, inadequate, or unfairly discriminatory. Great. However, a rate in a competitive market shall not be disapproved for being excessive, right? And so there's only currently, workers' comp has its kind of own piece to this. There's a separate piece of the law that starts around 41228, I think, and goes on after that. So, workers' comp, I do have authority to limit how much can be charged. There is an excessive component to the workers' comp law, and then there's currently only one line of business in the state of New Hampshire that's been deemed non-competitive, and that's medical professional liability. But otherwise, every other line of business in P&C insurance in the state of New Hampshire, I do not have an ability to disapprove it simply for being excessive. We trust in the competitive nature of the markets. It was really exciting to see all the corporate sponsors and all the different insurance companies that are involved in this activity. And then when I look at our reports and we look at financial data that comes in, and we recognize that there's like 70 or 80 different insurance carriers that are writing homeowners. There are well over 100 carriers that are writing most commercial lines. It's a very vibrant, very competitive market out there in every line of business, and that's going to keep your rates down. My big concern is to make sure that they're adequate, that the rates that they're charging enough, right? A rate in a competitive market, right? A rate in a competitive market shall not be disapproved for being excessive. A rate in a non-competitive market is excessive. It is likely to produce a profit that is unreasonably high. Again, that only happens in those two lines of business. My concern, again, is the other side. When is a rate inadequate? and the rate is unreasonably low for the insurance provided, and the continued use of that rate endangers the solvency of the insurer using it. And that's what Keith was talking about earlier. There is great concern if an insurance company is not, does not have enough capital, does not have enough dollars in their name to pay claims. And when that happens, we run into real serious problems with the market. Solvency concerns, but also the rate is unreasonably low for the insurance provided, and the use of the rate by the insurer has, or if continued, will have the effect of substantially lessening competition. If you're going to really undercut the other carriers in a market, then you're going to draw in, you're going to draw those consumers to you, right? You're going to undercut the market. There's the risk that you're going to end up in a monopoly situation, or you're going to force the other carriers to join you in inadequate rates, and then the whole market can spiral and it gets very, very dangerous for consumers. And so, believe it or not, I spend more of my time worrying about whether rates are, if carriers are charging enough rather than carriers are charging too much. And that might seem counterintuitive, but it is our concern at the department. And then the final piece deals with unfair discrimination. Unfair discrimination exists if, after allowing for practical limitations, price differentials fail to reflect equitably the differences in expected losses and expenses. Basically, the premium has to match the risk. If a particular exposure is more risky, if the person driving the vehicle has 3 speeding violations in the last 5 years, it is reasonable to charge them more for insurance. They are more likely to have a claim than the person who follows the speed laws. Okay, so then we just get into a little deeper into what we're looking for when carriers provide a rate filing. In determining whether rates comply with any of these, whether it's the excessive standard in a non-competitive market, the inadequacy standard, or the unfair discrimination standard, we expect due consideration shall be given to past and prospective loss experience within and outside the state. If you don't have enough experience here in New Hampshire, then yes, look at your region. Look how much you've been selling, you being the insurance carrier. What is your experience in the region, in New England, in the Northeast, especially if it's similar exposures, right? If you're doing homeowners, it may not be appropriate to price your New Hampshire homeowners policies because of your experiences in Louisiana, right? So, and then we can talk about how to complement that experience with other data, other information. But, if you're selling auto policies and you've been writing in Maine or Vermont, it's not going to be hard to then translate that over to New Hampshire. Other things to consider: reasonable margin for profit and contingencies, dividends, savings, and unabsorbed premium deposits allowed or returned to insured policyholders, members or subscribers, to past and prospective expenses, both countrywide and those specifically applicable to the state, and to provisions for special assessments. How are you controlling your money? Where is it coming from? And then what other expenses do you have? And then we talk about, again, fairly discriminating your customers, right? Risks may be grouped by classifications for the establishment of rates and minimum premiums. Classification rates may be modified to produce rates for individual risk in accordance with rating plans that establish standards for measuring variations in hazard or expense provisions. If, for whatever reason, if you can demonstrate that one risk is more likely to cause greater loss than another risk, then it is appropriate to charge them differently. At the bottom, no risk classification, however, may be based upon race, creed, national origin, or religion of the insured. These are protected classes and may not show up in a rating manual. The expense provisions included in the rates to be used by an insurer shall reflect the operating methods of the insurer. This is the other acquisition fees. This deals with whatever it may cost the insurance carrier to produce that policy. Reasonable profit I don't get into what is a reasonable profit all that much, although lately I have been pushing, at least asking carriers, is this profit reasonable? Because I don't have an accessibility standard that I can meet, that if the insurance carrier, it becomes difficult in my position because of that constraint. But I have been asking carriers about, profit and contingency piece as the insurance rates keep climbing, especially on homeowners. So that was 412.15, which kind of lays out what a rate needs to be. 412.16 deals with how do we read it, what is provided to the insurance department, and 416.2 basically says everything that the insurance carrier uses to develop premium needs to be submitted in a rate filing. So every insurer shall file with the commissioner every manual, predictive model, or telematics model, or other model that pertains to the formulation of rates and/or premiums, minimum premiums, class rate, rating schedule, or other plan, and every other rating rule, and every modification of the foregoing which it proposes to use. So basically anything that the insurance carrier is going to use to develop a premium needs to be submitted and have on file at the department. And if it turns out that they're developing premium some other way, and then we find out, we will push back on them. And then I talk to Emily and I talk to Josh, and if we need to investigate, we do. Personal lines filing shall also include underwriting rules, and that's specific for personal lines. We need to know how they're placing the business, where they're placing the business, who they choose to write and who they don't, who they're refusing to write under what circumstances. And we need to have those filed with us, and we need to make sure that those rules are, clear, objective, mutually exclusive, that there really isn't any subjectivity involved. Because we need it to be consistently applied, or it's going to be unfairly discriminatory. All right. So then what else do I need to see in the rate filings? Every insurer shall file or incorporate by reference to material that has been filed with or approved by the commissioner at the same time of the filing of the rate, and this is the key, all supplementary rating and supporting information to be used in support of or in conjunction with the rate. Basically, how did you come up with these rates? What did you use? What was your experience? What was your data? How did you analyze that data? What did you do with it to develop these rates? Because you need to demonstrate that these rates are appropriate to develop adequate premium that is applied without unfair discrimination. The experience or judgment of the insurer or information filed by the advisory organization on behalf of the insurer is as permitted. So 412.23, that describes the actions and responsibilities of the advisory organization. That's ISO or AISS, anyone that's providing loss costs or rules for the carriers. Its interpretation of any statistical data relies on the experience of others or advisory organizations or any other relevant factors. Again, how did you come up with these rates, these rating factors? And you got to show me what you used. Show your work. When a filing is not accompanied by the information upon which the insurer supports such filing, the commissioner may require such insurer to furnish the required information. This is where most of my objections come up. Insurance carrier will say, yep, these are the new rating factors we're going to use. We're filing them with the department. And then I go back and I say, please provide actuarial support for the proposed rating factors. They need to demonstrate that these rating factors are appropriate. Until the requested information is provided, the filing shall not be considered complete and may be subject to possible disapproval. There we go. So what's happening in a rate filing? Like, why do insurance carriers provide a rate filing? There are two big reasons, right? One, they need more money, right? They've realized, there has been an across-the-board change in the cost of coverage, and the carrier needs to charge usually more for policies going forward, right? So that's your base rate change. The other possibility, and a lot of times these are combined, is that the carrier has noticed a change in some classes of insured. There's some characteristic that they're experiencing adverse selection, right? So they're charging too much for the better risks and not enough for the worse risks, and so they're getting a lot of you've seen this happen, I'm sure, and it can be very difficult and sometimes unrecoverable for an insurance carrier. So they need to adjust their rating factors. So again, we're going to be using the homeowners example, but what I'm going to be going through, it applies to all lines of business, and I see these submissions come in for all the lines of business, whether it's personal lines or commercial. But we're going to go through a homeowners example. Carriers will adjust rates by comparing loss experience to what they believe they can afford to pay out. So what they believe they can afford to pay out is often called this permissible loss ratio. This is where an insurance carrier will develop, they'll provide an exhibit that deals with, their investments, their return on investments, what they believe their rate on investment ought to be. They back out their taxes and their expenses and whatnot, and then they wind up with a number, and they say, we can afford a loss ratio of 58% or 52%. And then they go and they look at what their experience has been recently, last 3 to 5 years usually, and they say, oh, we're running a loss ratio of 72%. That's not sustainable. We assume it's going to continue similar to the way it has been recently, and so we need more rate. And then, of course, they include, and it's appropriate to include these other carrier expenses, commissions, tax, license fee, and so forth. So what I wanted to do is, this is a very, very busy slide, I get it. This is an actual rate indication that was provided or submitted to the department for my review a few years ago. What does it say up there? Projected period. So then this is new. They're proposing new base rates to be in effect in 2025. So this was submitted to the department probably in the summer of 2024 or so. So what we're looking at here is kind of it's a pretty good example of a concise rate indication exhibit, and this is what I see almost every day. I wish more of them were laid out this way. A lot of times carriers, it's kind of hard to see what they're doing. I used to teach high school math, and I'm often reminded of why I left teaching high school math. Carriers are supposed to show their work. If you haven't understood what I've talked about in the last several minutes, is that they're supposed to show their work. They don't all show them as neatly as this carrier did. I did black out. I redacted the name of the carrier just because I didn't want you to pick on them for their numbers selection. But I will shout out to them that they did a pretty good layout of the indication. I know it's pretty small. So what I'm going to do is I'm going to, the next few slides, kind of pull out each of these pieces of the indication. But if you see what's in grayed out over there, what that says is the proposed, gosh, I can't even read it. Yeah, proposed rate change. That's what they want. So they need to increase overall base rates by 10%. And that's what they're saying. Everything else in there is defense for that. So we're going to look at that top piece first. And what the top piece says is that, hey, we've looked at these 5 accident years. So we went from 2018 to 2022. And we've looked at our exposures, we've projected our premium, so we need to account for other rate changes that may have occurred in the last 5 years to pull everything up to kind of today dollars. And then we did the same with losses. We trended those losses, so that's why it's called projected ultimate loss. This is what that same experience might cost next year, what we expect it might cost next year. And then so that's where we get a projected loss cost. And then we're going to weight those. We put a little more weight to our more recent experience than we do to the older years, or it might have to do with the fact that there were more exposures in current years than prior years. And so they did a pretty even weight over those 10 years. And so then the weighted projected loss ratio. So this is what we're saying, 56.7%. That's what we've experienced, right? And so that's what they're going to take and put up against what they think they can afford, right? So then we look at that next box. So this was in the box on the top left over there, whereas it's called the derivation of the indication. So they take that 57.6%, they add on LAE, loss adjustment expenses. This is, it's 6% of their claims, and that all boils out to about 3% of total premium, which you saw at the pie chart earlier. And so then they multiply those two numbers together. They then incorporate their permissible loss ratio, which is on another section. It's actually, it's item number 16, which is nice, easily referenced, which I appreciate, to develop what's called a raw indication. They're saying, hey, we can only afford 48.2%, but our projected expenses for claims and adjusting is 60.2%, and so we really need almost 25% rate increase. And then we say, well, how credible is your data? How reflective is your experience to what is likely to happen next year? And then there's a whole branch of mathematics called credibility theory, which we're not going to get into today. I understand just enough of it to convince folks I know what I'm talking about. But ultimately, they provide another section of this indication to say, hey, we're about 52% convinced that the data is good and usable and reliable. And we say, well, that's not very good, so what are you going to do? How are you going to account for that other 48% lack of credibility? And so that's where we use what's called a complement of credibility. There's another little box on the indication that we'll talk about in a moment, but basically that's that other piece. That's that other piece that we're more confident in. And so and essentially right now, because it's a 52% credibility, it's basically a simple average of the two. And so that's where you say the rate level indication, they're saying they're producing a rate level indication of 15.9%. And that's what they're saying. That's what their actuaries are telling them they ought to increase their rates by 15.9%. And so they're saying, well, this is very often the case. Carriers like, well, we don't want to really do that to our customers, so we're just going to raise the rates 10%. Can you please let us raise the rates 10%? Yes, absolutely. Provided you've supported all your other numbers, this is a perfectly reasonable approach. You see where it says up there in item number 2, and it says LAE loading, and then it says Exhibit L. Yeah, there's like 15 other exhibits that get stapled to this top page. So it's not just this one page. You're going to see a bunch. We're not going to go into all of those, I promise. But there's a lot more support that goes behind it. And if all that seems reasonable and it's well supported, then yes, they can take a 10% increase for an indication that says they need 16. So we're going to go through some of those components. And again, exhibits, we got exhibits J, M, K, okay? And this is where it talks about those other expenses. So derivation, this is how how the carrier develops a permissible loss ratio. Because they have to consider, okay, well, we're going to pay our producer, we're going to give our commissions out to our producers at 19%. That's how we need to keep our business going. We have to pay our taxes, licenses, and fees. Other acquisitions we've been seeing, and that Exhibit J is going to have their experience over the last 3 to 5 years again as to what they've been paying in taxes, licenses, and fees. What kind of actually, other acquisition and general expenses deal with overhead, and they deal with if they have to rent, a building, or if they have maintenance, or if they are dealing with marketing or things like this, right? Underwriting profit and contingencies, Exhibit M is going to be that return on equity financial disclosure that I talked about earlier. Reinsurance expenses, Exhibit K, they're going to tell us what they've been paying in reinsurance in the past. They may share some analysis from their reinsurers to indicate what might be changing recently. And then as they add all that up, subtract from 1, and you get your permissible loss ratio. And then that gets put back in here, top right, and it feeds into the derivation of indication, which is there. So we just need to talk a little bit about calculation of credibility. Usually credibility is based on the number of claims that they've had, and it depends whether you're using, they have a credibility standard of 5,092, with an experience over 5 years of 1372. The calculation is you divide those first two numbers, then take the square root, and that's how you get your credibility. How they develop, there's a little bit more work that goes into how they decide on that credibility standard, and it has to do with whether you're using the, renewal policies. Like if you're using the same home with the same owner, so for several years, that's going to be a little less credible than if you have different policies with different homeowners and different homes each year. And so, some of that has to go into it. Usually auto claims for an auto policy, the credibility threshold is 1082 is the number you see most often, as long as there's a lot of independence within your sample. And then sometimes carriers that are new to the business or don't have a lot of claims, if it's a very, especially in commercial lines where it might be a very high severity, low frequency situation, then you might not use credibility on the claim side. You might end up doing credibility with the exposure side, and then there's other calculations involved there. Sorry, I digress. Complement of credibility. So in this case, so we think it's about 52% credible, our experience, right? So what are we going to do to balance that off? We're going to go and come up with just a strict, straight up, let's apply our trend factors to the anticipated losses straight up, right? So if we did nothing and only dealt with trend, right? So we're looking at the market, we're looking to see how expensive it is to rebuild homes, to repair homes. What is our, how is our premium developing? By how homeowners are, what types of homes they're purchasing. Is coverage A going up a lot, or are there more ancillary pieces and coverages inside the homeowner's policy? So annual premium trend, annual loss trend, that's a simple multiplication between among those, a simple calculation to develop, hey, if nothing else mattered, then we're looking at an increase of 6.3%. So that's how they develop their complement of credibility. So if we had no experience, we were just looking at the market in general, we would expect a 6.3% necessary increase. And so then that's what they decided, and that is reasonable. Of course, Exhibits F and Exhibit C are going to be defense and support for those trend selections. And they're going to look at, usually they look at regional trends, they may include, not so much in homeowners, more so in auto, where they'll look at countrywide trends. So that's one side of it. That's if we need to do a rate change across everything, a base rate increase in most cases. But then the other piece down at the bottom is the carrier has noticed a change in some classes of insureds, or a whole new class that needs to adjust how premium is charged based on risk characteristics. So they're saying, hey, we need to adjust, again, the fear of adverse selection drives carriers to constantly find new ways to differentiate their risks, right? And in most cases, so there are two basic ways. Sorry, this is pretty small. But they're basically the traditional way, which we don't see a whole lot of it anymore. The traditional approach is to do what's called a rate relativity exhibit. So you have your characteristic, and the characteristic, the variable they're dealing with, I made these numbers up. I mean, this is consistent with what I've seen in the past, but I really couldn't find a very good example. In this situation, I picked the variable, the risk characteristic, to be prior losses, prior paid claims in homeowners, right? And so do you have 0 prior paid claims, 1, 2, or 3 or more? This is a very, very common rating factor. So what we'll see is that they'll come back and they'll say, the carrier will come back and say, in our experience, in our recent, book of business, we're seeing that if you have 1, 2, and especially 3 claims, you're going to be a lot more expensive to cover going forward. And so then they provide the experienced loss costs, and then they will do what's called a loss relativity. They basically divide the costs of each of the other classes to that base class so that it justifies that surcharge, right? However, maybe the 15, let's say 1,500, in that one loss group, that one paid claim group, that's probably pretty credible. But then the other groups are really, really small. And so I would not expect carriers to then apply that full relativity. And so you see what's happening over here. They're saying, well, we really should be charging 40% more, because our experience tells us we should be, this 40% over here. We should be charging, anyone who has 2 losses should be getting charged 40% more. And I'd be like, no, you don't really have enough data to defend that. And in most cases, they don't try to take that full relativity, but they know they need to be charging more than the 25% they're currently charging, and so, yeah, they're going to bump it up a little bit and then continue to collect data, right? And so we see these relativities from time to time. Becoming much more common, however, is to use predictive model and predictive analytics, okay? And what these models do, and there are many different kinds. The most common had been the generalized linear model, because there's really good software out there that does a lot of computing at a very quick pace, they can throw in sometimes hundreds of variables, certainly dozens of variables into an algorithm, and then let the machine run for sometimes a couple of hours or a couple of days, and spit out an appropriate model for the type of risk we're talking about. And then and we ask for lots and lots of support for these things. It is not just one graph, okay? But we need quantitative and qualitative descriptions of these variables, how they select each of the variables, what was the method, what was the process for developing their model, what software did they use, how many iterations of the process did they do, tweaking different variables, pulling variables in, sitting variables out, and these sorts of things. So there is a lot more to it, and carriers will provide hundreds of pages of documentation. However, one of the big support pieces, and ultimately what they want to do, is come up with a new rating methodology, a new rating plan, new rating factors that improve the lift. The lift is the orange line, the green line there is what the new model produces relative to the orange line, which is experience. So what you see here is they break down their book of business into, sometimes these are deciles, sometimes they'll do 20 buckets, which I think is quintiles, I forget what the word is. And they'll say, okay, we arranged all of our experience, all of our records, all of our exposures from the least risky to the most risky, okay? And then we're going to rate them by the old method and by the new method. By the old method, okay, the loss ratio on the least risky business was only 40%, right, 0.4. Well, that's not really fair. We're not, we're only paying out 4 cents on the dollar for claims. We're overcharging these people, right? However, at the very other end of the business, we're looking at the orange line because that's experience, right? At the far other end of the business, it's almost, we're paying out twice as much as we collect in claims. Well, we're obviously not charging them enough, right? And so then the model then will provide a better alignment of rates so that the premium matches the risk, right? So then the green line is that readjustment. It's never, ideally it would be one across the whole screen, right? Because we want to charge the right amount of premium, for each risk, but it isn't perfect. And so they will provide this to show that it's better than it was. And that brings us to the last slide, which is just a recap. Basically, when carriers provide a rate filing, they need more rate, they need to redistribute their rate, they need to introduce a new variable. They must provide any of those rate changes for review by the NHID. Carriers must include in the rate filing support for all components of the rate submission. You have to show your work. Carriers must account for the credibility of the experience they were relying on. If you're only selling a couple of hundred policies in the state of New Hampshire, your data is not going to be credible. You need to go and pull in more experience. If you're writing business in a neighboring state, that's great. If you need to rely on information from other carriers, that's okay. Especially if their rates and rating factors have been approved by our office, then we prefer you using their rates and rating factors than just throwing darts at a dartboard. Carriers must be able to demonstrate a correlation to risk for the proposed rating factors. And this is where we can be helpful if any of your customers run into problems where they just don't understand why their premium is going up, 150%. Come and talk to us. We can certainly investigate. We can look at the carriers. If the carriers are being difficult and not providing information to the consumers, we do. We can help there.